Ladies and gentlemen, good evening. This is Christopher Aaron. It is October 24th, 2018. This is the closest that we have been to a stock market crash since I've been producing these videos, and for that matter, since the bear market lows of 2009. So a lot of the things that we've been talking about over the last few months, these broad macro themes that are coming together, a lot of these things are starting to show signs of manifesting. And I would just say this is a time to really look at your own position. Are you too exposed to the stock market? Do you not own any precious metals at all? If you're completely new to the precious metals market, I would just tell you to be careful, because there are a lot of unscrupulous salesmen out there who will try to sell you gold and silver in forms that is going to cost you much more than you should be paying. So I simply approach this from an independent standpoint for the benefit of individual investors. Know that you can reach me on the website if you would like to speak one-on-one about tailoring a strategy to your needs. Situational awareness. We're going to talk about this. Even as precious metals investors, there are times where we must follow what is happening in these diverse markets, such as the stock market, such as the bond market. And this week, we're going to look at the stock market. This is an important setup that is happening right now from a technical basis. And this is going to be sharing of some of the premium content that is going to be coming out this weekend. And of course, we will dive into these topics and more in the premium subscription when that comes out on Monday. The type of analysis that we do here is technical in nature. But that said, I believe technical analysis gets a bad reputation sometimes because it can be overly complex. And I think actually sometimes that is done deliberately to try to make it seem, more high level than it really is. But I take some of my inspiration on the major trends of technical analysis from none other than this fellow, Henry Thoreau, who I'm fortunate enough to have grown up in the same part of the world as. Of course, we're talking about this quote, "Our life is frittered away by detail. Simplify. Simplify." And so some people will say that the form of analysis you are about to see is too simple, but I would tell you that the most simple form of technical analysis tends to be the most powerful. In the 15 years that I've been studying the markets, that has been in my experience for being on the right side of the market, is to look at the major trends that are in play. Let us take a look. We're talking about the U.S. stock market. Let's bring up the S&P 500 index from 2015 through the present. The lows of the 2016, late 2015, 2016 bear market shown here around 1,800. And then almost a 50% rise, over 50% rise over the last 2.5 years. And the signal that we are looking at now is what is referred to as trend analysis. So we'll bring up this key. Everything is going to be color coordinated here. We are looking at trend analysis. So we draw the most basic, the most simple, but the most powerful form of trend analysis that can be done. We're talking you must start from a major low. You must connect the major lows that formed through the rise. You must do a best fit type of analysis, connecting major lows, and we see what a breakdown. From this blue trend line, blue, according to the key here, we are talking primary trend lines. Primary, we're talking generally multi-year trend lines. 1 to 3, sometimes up to 5 years we're talking about here. And now some of you will say, well, this best fit line, look, the price cracked below it a few times over here, and this hit didn't quite touch it. This is what is called a best fit. We're talking statistically, where does the trend exist? Now, what we can do to make this even more powerful when we're looking at this market is we can draw another line calling this the absolute lows. So connecting the absolute lows of these corrections back from February and April, and we can call this in sum a support zone. So we can see sometimes markets don't respect a particular level exactly to the T. Markets don't always come to the exact point that we would hope they would. Sometimes they give false little moves below, And so it can generally be beneficial when you're evaluating markets to consider support zones, not just support particular levels. No matter which way we evaluate this market with the support zone here in the S&P 500, we are seeing what? None other than this. Let's call this a significant trend break. Okay, this has not happened in over 3 years. Stock market was down over 3% today alone. We've seen a number of these days over the past several weeks. We've been talking about this setup, that we had to see this trend of buyers, this trend of rising buyers break to give us a signal that this market may be looking to do something more dramatic than just these mini corrections that have shown up every 6 to 18 months over the last several years. So where are we now? As we look at some of the fundamental indicators, and so we've been looking at this, by the way, every several months. Premium subscribers will know we update this every several months. But we're looking at for example, the Buffett indicator. This is called the ratio of the total valuation of all corporate equities in the United States to the gross domestic product of the United States. And you got to think there should be some correlation here. There should be some ratio between the total valuation of all the companies and the total production of all the companies in the country. We can see this ratio moves in quite wide ranges over time, but we can see the single highest valuation of this corresponded with the dot-com bubble. We're talking about the stock market peak in the year 2000. Stock market fell about 45% over the next 3 years. The NASDAQ fell a whole lot more, but we're talking the broad stock market, 45% decline from this level. This is the second most expensive reading that we've seen in this fundamental indicator in all of available record keeping. So if that was a 45% decline, we could certainly be looking at something quite significant here. And especially when you consider that the market did not come back to a level of historical lows that we have data for. So this was something of an aborted bear market because the Federal Reserve was printing money, bailing out banks, bailing out insurance companies, and all that printed money ended up going back into the stock market. So we really had a failed move lower here in the stock market to bring us back into the region of long-term lows. So the fundamentals have existed, but we've been watching this every several months and saying, yeah, the fundamentals can exist, but the market can do something completely different for month after month and year after year. So this is the difference between technical analysis and fundamental analysis. We are looking at when does the market actually start to recognize those fundamentals. Big difference from the fundamentals themselves and when the market recognizes it. Now, what we usually do is we like to take a broader perspective. And here, let's look at the takeaways of what we're going to expect with the stock market. We were just looking at the blue parallel channel here. And what you can see is that the blue channel was, in fact, the beginning of a parabolic breakout from what was a longer-term, orderly parallel channel here shown in the magenta color. We're talking long-term. Back from the crash of 2009, the lows, the stock market has gone up over 300% to the peak. Pretty much in this straight line, straight channel higher, with these mini corrections along the way. Nothing significant as far as corrections have been seen. So what we're seeing here is the market had begun to move from a linear channel, we're talking y-axis valuation here, a linear channel, to trying to break that higher into something of a parabolic channel. Okay? And now this parabolic has failed. So what we've said in the past is that this is the signature of a market that is in the process of putting in a long-term top. We already saw the fundamentals. Those are already there. But we're looking from a technical standpoint, when is the moment that the market is actually starting to put in that long-term top? And one of those signatures. Now, what you'll have is, if you go back in time, you'll have people at each one of these tops, right? Each one of these tops calling the long-term top, saying this is it now. The top is in right now. And I tend to stay away from that sort of thing until a significant trend is broken. You know, calling the exact top is kind of a guessing game. There's very little point in it for the average person. Yeah, 1 out of 100 people will be right in calling the exact top, and they'll make a bunch of money from shorting at the exact moment, but it's really guessing. That said, there are these signatures. There are signatures of a market that was in a parallel trend that takes on a parabolic trend, which then fails. And these signatures tend to be the markings of long-term tops. So we're on alert now that a long-term top could be coming into play here in the world's largest stock market. What are some levels that I'm looking at to confirm, what would confirm the transition here from a bull market to a bear market? Let's look at it. So there's some support that we see immediately under the present price. So stock market closing just above 2650 for the day, coming down from 2900 or so several weeks ago. 2650. What are some levels to look at? Look at the dashed black line here. Dashed black referring to black horizontal support and resistance. Again, all we're looking at is levels where buyers showed up in the past. And we saw after that little mini panic in February, look at where the buyers showed up. Look at where they showed up once again several weeks later. All things considered, this is an area of support. Now, we've got this as a dashed black line as opposed to a thick black line to show that this was only really support over the course of about 2 months. All things considered, this level of support probably won't hold for more than a little bounce, which is what I expect over the next 1 to 2 weeks. A bounce down here at 25.50. Okay, so I believe this support will be failing now, and then the critical support level, the next logical support level, comes in at the lower parallel trend line that we have. So once again, going back to that quote by Thoreau, we're talking simplify, simplify. But it's just very easy to see here that until this lower channel breaks in a legitimate way, we have no business calling a long-term top definitively. We have no business doing that. What we can say is that the potential for a long-term top is now forming, and even if we have to wait for this lower trend line to break, there will be plenty of time to make money on the short side over the next several years, and also plenty of time to profit from asset classes that are going to rise, such as the precious metals, as this market rolls over. So the line in the sand here, if you will, for the S&P 500, what are we talking about? It is 2350. It's this lower, we're talking almost a 10-year trend line here. The lower trend line coming in at 2350. And if you want to ask me, I believe this market is going to be coming down into the zone between this lower black line and the rising support. I think this is the logical target. This will represent approximately an 11% decline from present levels and something like an 18% decline from the actual peak. So this will be really scary. This will be the first over 15% decline that the stock market has seen in almost 10 years. What is going to come after that? I will, of course, let the market tell me. If I were to take a guess, and I will admit this is a guess, if I were to take a guess, I believe this lower trend line is going to hold at this point. We will be looking at some confirming indicators for that, but I believe that this will hold, and the final breakdown that we need to see for a bear market to be confirmed will not be until sometime still significantly into the future. Perhaps later 2019, perhaps 2020 or 2021. That is my highest probability assessment at this point, based on the psychology that I saw up here. Getting frothy for sure, getting into bubble territory, but I think these bubbles can take on lives of their own and suck much more capital into them than is possible to imagine even as they are developing. Let us look at how gold and silver responded over the last 3 days to this stock market weakness. Looking at the price in gold. So we've had a nice rising trend here develop in gold. It's been a shallow rising trend, but a rising trend nonetheless. Gold definitely starting to get the message, so to speak. Definitely starting to perk up. And it looks like if we get another strong down day tomorrow, we are going to see gold break this 1240 region. Premium subscribers know we were talking about that 1240 region. We need to see a close above that to indicate gold is going to take on that accelerated move higher that we were looking at. So it looks to me like this is the challenge that is setting up. And if we get a strong down day in stocks tomorrow, I bet you gold will take this out, and we have some higher targets for gold over the next several weeks. Now, the most critical thing to take as we switch over and look at silver. We'll take a look at silver here, spot silver prices. Notice silver continuing to lag gold. For example, not making a new high for this move today, not closing near the highs of yesterday, whereas gold is clearly getting ready to challenge those highs again. We're down on silver today. So this is one of those really important points to consider if you are new to the precious metals and you're thinking, okay, I want to have some sort of protection from a potential stock market crash or a correction. Do you go into gold? Do you go into silver? And I will just say right now, and this is where if you are only wanting me to give you one message, if you only want to hear Chris cheering the precious metals higher, you're not going to get that at this channel. There's plenty of other channels that you can tune into and just have people blow smoke at you. But what I'm saying is this: silver does not do well in stock market crashes. There is an extreme amount of evidence for this when we go back and study the correlation between stocks and silver prices. So I would just say that if you're new to the precious metals, and especially if you are looking at getting involved in the mining sector, you need to be really careful about how you're allocating at this time. Because if we do get this mini stock market crash here, or if it turns into, can we imagine, a true stock market crash, if it turns into a 1929 style of event, you have to be very careful about your allocation between gold and silver, and furthermore, when you get into the silver market. There is a time when silver will outperform gold, but it is not as the stock market is actually crashing. I do want to thank you for watching this video. As I said, Henry Thoreau, one of the great libertarians of our lifetimes, who believed in self-sovereignty and connecting with nature and the abolishment of slavery. All these things as he spent time alone in the woods, bettering himself. When we look at that advice of keeping things simple, I want to let you know that is why I've gravitated. It's one of the reasons why I've gravitated toward this form of analysis. It does appear simple when we look at it on the charts, but I'm telling you, basic trend breaks, basic support and resistance, Fibonacci retracements, long-term, medium-term, short-term, and the classic charting techniques are the most powerful ones. We are seeing the hints of that breakdown at this point in the stock market. There is a premium service that covers all of this in much more detail. So we didn't even look at the gold and silver charts this time, and I told you one of the things we're going to be covering in the monthly members video, which comes out this weekend, is this silver versus the stock market question. What the evidence shows for this time thus far. We have all the historical data. We are going to look at what the market is showing this time. I want to let you know if you would like to speak one-on-one, you can reach me on the consultations tab by voice or by email. We can do these consultations. I have clients from all over the world, those beginning with their first $5,000 or $500, and they don't want to get taken advantage of, all the way to individuals with $5 million looking to diversify across the precious metal space, looking to get involved in private placements or some of the more speculative end of the spectrum. So please know that I take no commissions or fees from any of the companies or any of the ways of investing that I recommend. I simply look out Consider me someone who is in your corner, someone who looks out for you. Thank you very much for watching, and also thank you so much to all those who are supporting these free videos on Patreon. The link for that is below. I very much appreciate all the support. Watch those levels. Watch the 2350 level on the S&P 500 over the next several weeks. This is going to be a critical test. It will be a scary little flash crash that is coming. That is as far as I will go as far as a prediction. And when we get to that 2350 level, that is going to be the time to see how this market and how gold responds. Was this just a little mini flash correction here that's happening, or does this develop into the real deal?